Hello everyone, welcome back to ASX Market Watch and charting trend signals around the world. Thank you very much for joining me. It is fantastic to have you here. Couple of minutes, let's just spend a couple of minutes. It's not that long, but it is on your weekend, looking for the week ahead in the markets, of course, seeing where the world markets are heading. And we're going to look at the entire world this week as well. Just because it's been a while. And you know why it's been a while? Like, there's not much that it's been happening. When the markets are behaving themselves like they are currently, or they have been over the last couple of months. This is the All Ordinaries, this one. Look at that. I mean, it's only been three and a bit months, but we called it back in August. It was breaking out of that little range there, and since then the market has continued up in it's a minor bull market right now, basically, is what we're seeing, and it's been fantastic. The individual stocks on the All Ordinaries have been absolutely brilliant, but we'll look at the world just because it has been a while. Really quickly, the FTSE in Europe. Let's start there, shall we? It's very cool and very simple. This is the downtrend line starting from 2011, way back here, and it goes all the way till today. And hallelujah, would you look at that? Where is the market finding current resistance right now? Exactly right, it's at the trend line. And you'll find that this is a common phenomenon. It does happen very, very often. Now, looking at this on a shorter term basis on the FTSE, this single bar right here, this is on Friday, it must be. Yes, that's correct. This is the Friday's bar. But look at the where it opened on the left, went down throughout the day and closed well on its highs on the right there, that little tag, or that little tab there. So what that means is that's a sign of strength around this area. It means that there's buying at around 5,740 approximately. And so again, that's a good sign on a short-term basis. What you'll also tend to find is consolidation around the trend line. And that's exactly what we're seeing right now. Now, there's two ways that this can go. When the market finds consolidation, it means that it's happy with the price currently. What we're looking for is the times when it's not happy with the price, and that means that it will actually either move away from that consolidation. So yeah, currently happy with the price there, but something will happen around the world. Something will move the market perception, and it will either break out to the upside or break down to the downside out of this consolidation range, which happens at the trend lines. And incidentally, that's exactly what we were sort of calling over the last 3 months, is that resistance that was coming up. I was expecting it to sort of, happen around the trend line level. That's probably the most accurate level. Also, you can use horizontal support and resistance, which would have been at the 6,000 mark. But I prefer trend lines. That's just myself. Really quickly, the Dow Jones in America as well. What we're looking at here is currently, obviously they've had much more of a bull market on the Dow Jones in America over the last few months, few years even, really. I mean, if we look at, this is the bottom in 2009. It's gone up almost 100% since 2009. So happy days if you're investing in America. Obviously, people looking at fundamentals are struggling a little bit, but there's a lot of cheap money flowing around, and that seems to be flowing into some of the markets. Now, it has fallen away over the last few weeks, and what I'm just looking at here is the trend line. So again, like we were looking at trend line resistance on the FTSE, we're looking at trend line support on the Dow Jones, and that support level is at 13,000. There we go. So 13,000 on the Dow Jones. I would be looking, if you had a solid close below that sort of 12,970 around about there, then that would be looking at a bad sign on the Dow Jones. That would be looking at a sort of a short to medium term sell signal for myself personally, but this is a fairly solid support level. And again, sometimes you just got to wait and see what the market does and act accordingly, because after all, it's just trend following. So you're following the prevailing trend, and you're just waiting for that trend to unfold. Currently, it's up. On a short-term basis, it's sideways to down. And that would be the level to beat, 13,000 on the Dow Jones. Next up, let's look at Shanghai, which is in China, really quickly. And again, over the last couple of months, initially, this is the best bar, this one here. This bar, as I was saying, when it actually happened, it can mean two things. One is a dead cat bounce. It means if we've got this solid downward move, We might have one up move, which is the dead cat bouncing, as they like to put it, and then the market continuing down. The other way that it can mean is that something has actually changed fundamentally in the markets. It's really reacted. It's really changed the perceptions of the market participants, and that would mean that the market would actually continue upwards from there. So in the meantime, it's just in this range. And again, it's this consolidation range where people are happy with this price range, up, down, up, down, up, down, around this level. It means that there's nothing that's really changed the market perception. And what you'd be looking for is for something to change that perception economically, or earnings, or something. It could be on a large scale or a small scale. So it could be individual company earnings, or it could be something like monetary sort of policy or that sort of thing in China. So it could either basically, you just got to wait for it for the market to show its hand, basically. So you can't actually, I think that's the best way to play it, is to wait for the market to show its hand and to move out of that consolidation range. So it would either be heading up or down from there. And that's what happens. The market moves from movement to consolidation, from movement to stillness. It's always the way that the market has always been. And our job as market participants is to just take advantage of the times when the market actually moves. Now, speaking of market moves, let's get back to my home country and home market, which is the All Ordinaries, really quickly. And as I was saying, it was probably a few months ago now. See this little usually this would be a continuation pattern. It didn't unfold because it didn't break out to the downside, and instead what it actually did was break out to the upside right here. And since then, yes indeed, that has changed the trend. If you're following the trend, you see that little marker there, and that sort of signals that the trend is changing, and that's when you follow that trend, which at this stage is up. Now again, things are starting to get a bit shaky around the world, but all you can do as a market participant is follow the prevailing trend. And that could be on a short-term basis or a medium-term basis. Medium-term basis is my preferred method. But yeah, so looking at that, there's still a fair way for the market to fall on the All Ordinaries if it wanted to sort of change the trend. So even though, yes, we are starting to see some falls away on the All Ordinaries, it's still got a fair bit of leeway there before the medium-term trend does actually change. So that's just the way I'm seeing it at the moment. If we were to be looking at targets, we'd be looking at a target of this previous range here, which was from August 2011 to May 2012. And what we're looking at currently is that the market has reached its 75% extension of that range. So it definitely has reached that initial range. Usually you'd be looking at 100% retracement, or 100% extension, sorry. But again, these are just targets. You still have to follow the trend and just sort of wait until it shows its hand, as I usually say. Looking at individual markets in Australia and on the All Ordinaries, let's check this out. This one here, the red line is the market or the sector, and the blue line is the All Ordinaries. So this is consumer discretionary, so retailers and all that sort of thing. As you can see, currently underperforming the All Ordinaries and starting to head down. So I'm avoiding new buys in that one. Energy, the same deal. So any energy stocks like oil stocks and that sort of thing, they sort of do tend to fluctuate, but at this stage the overall sector is not a sector that I'm personally in. Financials is definitely one that I have been in over the last couple of months, so absolutely happy days. Healthcare again is outperforming the market. And, these are the things. It's just a currently strong sector. And as you can see, it's been strong for quite some time. So when you see that happen, and that was in, I think it originally happened, if we just go back. Yeah, so originally it was happening in February 2012. And actually, if we look at the stocks within healthcare, where are we? Here we go. This is probably one of the best ones. And you know what? I actually was not on this trade personally, and I'm just crying myself to sleep every night because of it. But look at this trade. This is just so beautiful. And it was in the strong sector at the time. It reported solid earnings at the time as well, which is this. See this gap? This is the gap. That's the earnings day, basically. That's the day it reported earnings. Can you not get a stronger sign than that? I mean, we've obviously got fundamentals matching up with the technicals, because if you're reporting strong earnings, the price gap's up. traders and investors are obviously happy. And what does that mean? That means the post-earnings announcement drift, which is a rule that states that that a stock will tend to drift upwards for 30 to 90 days after a positive earnings surprise. Let's just check this out. This is in February 2012, and you know what? Shablam and Kazam. It doesn't get much better than that, does it? I mean, and especially if your risk per trade that's your entry around there. And that's just the buys and sells at that level that I've marked there as well. But if your entry was there and your stop loss was down here, you've got a risk of about $2 approximately. And so moving up, so 1, 2, 3, 4. That's 4 times your risk already. 5 and 6. So we're looking at a 6-bagger at the moment on that particular trade. Other trades, actually one that I am actually on in healthcare is Australian Pharmaceutical. Oh man, this is one of my favorites right now because this was around this level as well. As you can see, the market did report earnings around this level too, and it was a simple breakout trade. So here's your breakout, and these arrows, this is just buyers to sellers, so the market depth. But yeah, you can ignore those arrows if you want. What I'm looking at here is, so it breaks out to the upside, it runs up, and it consolidates for quite some time. So as we were talking about, the market found equilibrium. It was happy with that price. It was happy with that market price around that level. Didn't really feel the need to move until coming back here, we have another breakout. And so obviously I just left this trade like it was still there. It wasn't going anywhere, but it wasn't selling at the same time. So I just held on to it. And in the meantime, it's made another breakout, which is just right here. So there's your downtrend line. It's sort of made another breakout around that level. And since then, happy days. It's definitely continued up, and it's very strong. The price action on this chart, anyway. So yeah, just beautiful stuff. That's why I personally follow the sectors that are outperforming, and yeah, it's just sort of the way that I put probability in my favor. Everyone is different, obviously, so people do it differently, but that's just the way that I personally do it. This is materials, so resources and that sort of thing. Materials still underperforming, and it makes me sad every day that this is happening because Australia loves its resources. It loves its, its mining stocks and all that sort of thing. But unfortunately, yes, the overall sector there is still well underperforming, and that means that I tend to avoid trades in that sector just because the probability isn't good enough for me in that way, like according to my particular method. Industrials is a similar thing. So your industrial stocks, these are your staples of society. Things like Bradkin and that sort of thing. The stocks like that, GUD Holdings, that sort of thing. And again, it is still underperforming. What is outperforming, though, is real estate. Booyah! That is amazing. And, actually, another great trade that I've had personally. This is my portfolio here. Charter Hall. Charter Hall has just been great, and the dividend is actually quite tasty as well. So excellent. Love that. What I'm looking at, as you can see, just these markers, that's an announcement. That triangle there, these are just my personal markers. That's the breakout. So looking at a breakout around the 240, sort of 240 to 246, 245. And then since then, and again, if you've got your risk just below the previous trough, what's that? What's that, about 15 cents? So 1, 2, 3. So about 3 times your risk. Looking at that particular trade right now, not as good as CSL, but still not too bad. Anyway, I think that gives you a rough idea. Hopefully that's given you some insight into the market. I love the market, but find a boring method. Find a method that just bores the heck out of you, because they're usually the most successful methods. And my method is not hard in any way. It's very, very simple. It's ridiculously simple, actually. Pretty much anyone can do it. But it does tend to work when the market moves, and that's what we want. Anyway, have a great week, guys. Don't party too hard, and I will see you next time. It's always great to catch up. We'll catch you next time for another Market Watch. Happy trending, and bye for now.